Hi, it's Friday, September 10th, and I think, as you know, I've been predicting that we may actually see a top to this long and bubble of all bubbles in the stock market, and of course bubbles in everything sooner or later, real estate, bonds, everything. And this is looking potential here, which I'll get to in a few minutes. But back for the big picture here, my most important fundamental cycles, there's three of them: a demographic, technology innovation, and the geopolitical. It's the demographic 40-year approximate and 45-year, more exact, technology innovation cycles are the most important to the economy and when it booms and busts. The demographic cycle peaked back in 2007. That's why we've had to live on quantitative easing ever since. Nobody's figured that out yet, but of course not economists who understand nothing about demographics, it seems. The technology cycle would have normally peaked around late 2019, 2020, and we would have seen a crash of that into late 2022, and the bottom of the demographic cycle comes in late 2022 for stocks and 23 for the economy. So I've been harping on this date for decades, saying that the late 2022 for stocks is likely to be the lowest point we'll see in our lifetimes. Now, with so much stimulus pushing this boom and bubble a little later, the actual bottom could come more as late 2023 in the economy after that. But I think the worst is going to happen, and we're running out of time for the central banks who are fighting the strongest cycles in our lifetimes, basically, and more comparable to coming into late 82 or late 1932. So this is a time when we're expecting a crash, and a top is likely into mid-September. One of my target dates. If we see a more muted correction here or in the next few weeks, then it'll say no. Maybe November's the next big target. I think September is more likely. It fits better with past cycles and short-term cycles and stuff. But again, we're dealing with something that no longer is rooted. I mean, I was able to predict the late 2007 top in stocks and the economy momentum decades before because it was set in stone. This is not like this. This is all stimulus. Now, in my newsletter for subscribers, I've had a channel we've been going in, and I love it. Most tops come in channels or wedges, and that gives us some guidance of when it's getting overvalued or when it breaks that important bottom trend line. Well, this channel looks like it's turning into a wedge. That's a good thing. The wedge narrows and gives us tighter targets for when we're breaking above and to sell, or when it breaks below the bottom trend line and you sell definitely there. So that's good news. My most favorite chart right now, because it's more clear than the stock. I mean, the stocks clearly look like they're in a peaking wedge, just a matter of when, and probably sooner than later. But the high yield bond market, HYG is the ETF. These high yield bonds are like stocks more. And when times are good, people will take more risk because the risk of default on these higher risk bonds is less. So they move up more like stocks in a boom, just not quite as much. And when they crash, they move down, just not quite as much as stocks, but much more than other bonds. So the HYG chart is just this wedge that keeps banging up against this kind of 89, 90 level and cannot break it. It's in its third attempt, and the third attempt is likely to fail and does not look like it's gonna break up. And the down projections, every time we've tried to break this level and had a correction, the correction's been sharply lower lows. So that's the best pattern. This chart says we can't break up pretty soon, that we're likely to crash down 51%, give or take, and as much as 60%, depending on how long it takes. That would be commensurate in high yield bond crash to a 70 to 85%, say, crash in stocks, which is what I've been looking for. And that just really depends on how much credibility they still have to stimulate once this crash happens. But I am saying they have stretched this market so long, you're not going to be able to stretch it much longer. The diminishing returns on debt from Lacey Hunt and money velocity, are really saying that we're at levels almost in the early 30s where we keep adding more debt to keep this bubble going exponentially. But the debt cost us as much, but returns less and less, and that's where you get in a bad situation where it's just not sustainable. So I am looking for a top, maybe right here between any time from here on out, but particularly maybe by late next week if the market keeps trending up and we hit some nice numbers like 4,600 or a little bit higher on the S&P. But man, if we break that lower trend line around 4,450 maybe next week or so, that's when you got to get really serious. This is a time to decide how much you love your stocks, how much you love your real estate. This is not going to be another correction. And just like I said in the bond market, every correction since 2000 have seen lower lows. We got that giant megaphone pattern, and it says just the first crash is going to be 53%, and then broader, we could go down as low as 5,000 on the Dow from 35,000 a day. So again, big picture, greatest bubble in history, looks closer than ever. Short term, this could be a top imminently, and if not, I think the second highest target is mid to late November coming into Thanksgiving. I do not see getting through this year without topping. And I do see 2022, highest chance I can give you, will be the worst year for stocks in your lifetime. So I will keep you updated.